Covered call double dipping. What is it and what should you do if your stock just goes whoop, down? All right, so in this video, I'm going to talk about what is double dipping, and I'm also going to talk about two other strategies that you can utilize when the stock does go really far down. And you can kind of take these same concepts for cash secured puts, but in the inverse if the stock goes up. So double dipping. This is where, let's say you sell a 60-day call option. So you buy some stock and then you pick a strike price that you're like, you know what, I'm okay with selling my ABC XYZ stock at this price point. But then the stock goes down. So now if the stock goes down, obviously what's going to happen is you're going to be at a loss, most likely if you just bought that stock. But your call option is going to show it's a profit. The call option is going to really decay in price. There'll be some time decay, but mostly, especially with the stock going down, you're going to see a lot of gains with that. So now what you can do, what double dipping would do is you're going to close out the call option and you're going to hope that the stock goes back up, and when the stock goes back up, you sell it again. This is okay in a volatile market, and something to understand with this is probability of touch. I'm not going to go into the crazy statistics about this, but probability of touch has about 2 times, a little less sometimes, 2 times greater chance than probability of being in the money. So, okay, long story short, if you're selling call options and if it has a delta of, let's say, 30, right? That means you have a 30% chance of being in the money, so a 70% chance of being out of the money, so expiring worthless, but your probability of touch is going to be higher. So what I mean by that, you actually are going to have a 60% chance instead of 30, 60% chance of it possibly hitting there. Anyhow, I don't need to bore you with this stuff. But that's important to understand because if you're in a volatile market, you may have a good chance of it going back up. So that's okay to do that. However, in a market that's maybe not volatile or maybe in a bear market where you're not very certain that it would go back up, this is a very bad thing to do because now what's the worst case can happen? Well, the worst case can happen is the stock keeps going down and now you're not collecting any premium at all. So what you could do instead is just wait it out. Like just don't do anything, just let it ride down. That's an option. Another thing you could do, 2 more things I'm going to talk about. So that's kind of waiting it out. Second thing I'm going to talk about is rolling it out. So rolling it out is where you're going to pick the same strike price. So let's say you bought ABC stock at 100, you sold a 125 strike call, and then now the stock goes down to 80. Well, you could just go sell another 125 strike, but what you're probably going to want to do to still collect some premium is go much further out. So let's say you initially did 45 days or 60 days. Now you're going to go out and, it expired a little bit. So maybe you're going to go sell another 75-day strike or maybe another 60-day because you're just going to go further back out. With this, the good thing about this is you're not messing up with any of your potential upside, which I think this is super, super good for beginner cover call traders because the worst thing you can do is really not make a lot on the upside. Because if you think about a cover call, if you look at the max profit and you start to get into the math, in most cases, you have a much higher max profit from the capital gains of the stock rather than the premium. And it can depend what you're doing, but it could be 4 times, 5 times, sometimes 10 times more potential gains from capital gains than from the premium you select. So again, in this example, you bought the stock for 100, you sell a strike price of 125, well, you have $2,500 of potential capital gains. So here you have 2 choices. I can limit my potential gains, so I could take my $2,500 potential capital gains and shoot it down to $1,500 to collect a little extra premium. Now, here's the thing. You're never going to get more premium to make up for that potential capital gain. So the good thing about rolling it out to the same strike price is you're not limiting that upside gain. In return, you're getting a little extra premium. All right, but long story short, you're lowering your max profit, so that's the con. Now, the next thing I want to talk about is selling a new option. And what you would do, it's a different strike price. In this case, it's going to be lower strike price, but you're going to probably aim for the same amount of premium, maybe the same amount of ROI, or maybe the same amount of probability of being profitable. Now, those 3 terms are kind of all the same, essentially, but again, let's say stock goes down to 80, so now you sell 105 strike price because you're really, really shooting for that premium. You really, really want that income. The good thing with this is that if the stock continues to go sideways, stays a little bit up, or continues to go down, you're in a better situation. A lot of cover call traders kind of feel embarrassed or feel like a sense of loss or failure when the stock goes down. However, you shouldn't feel that way. You should actually be a little bit excited and be a little bit grateful because you're better off than a stockholder. You're better off than somebody who's just buying and holding in this case. Because think about it. Person A buys stock, person A buys, or person B buys stock and sells covered call. Stock goes down, who's better off? The covered call seller. So you're literally better off than everyone else. So, that's nothing to be, kind of feel like you're a failure of. You actually did a lot better. So this scenario is definitely more of a bearish sentiment. And, again, you're really truly reducing your max profit, but at the return of possibly keeping the same ROI, maybe even greater. And collecting that more premium, and this would work really, really well in a bear market. So to recap this, if your stock goes down, and for cash secured puts, it's just everything is the inverse. Okay, so stock goes down, what can you do? You can wait it out. You can try to time the market. So buy it out, wait for it to go up, or just wait it out, let it to expire 0, or you can roll it out. So you can roll new option, same strike price, just further out. You're kind of just, what you're doing is just pushing the can down the road, but with that, you're getting a lower ROI, you're getting technically lower premium, but you're keeping your upside gains. Or you can lower your upside gains, sell a new option, keep the same premium, same ROI, and that's what you can do. So if you like this video, I would really appreciate if you can subscribe. I'm the founder of Option Scout, where we build software for options traders, working super hard for all of you to have some really cool tools. So I really appreciate if you can subscribe to this channel, hit the like button, and I'll see you in the next video.